Whenever a taxpayer deals with property, the first provision and the gateway provision to always consider is the general realized gain or loss rules. I want you to recall that when we defined gross income in a previous discussion, there's really three components to determining whether someone has gross income. There must be an accession to wealth, clearly realized, and dominion control. Accession to wealth is where the net worth increases. Dominion control, there's no strings attached to the specific item of income. Realization is the trigger event that allows for when we know that income must be recorded. This is what distinguishes, from an administrative standpoint, certain things like the increase in value of property, stock, your home, and whatnot going up, whether that actually has to be reported on your tax return. The realization component is crucial when we're talking about a realized gain or loss. So if you think back to that definition of gross income, that's going to be inherent in the whole realized gain or loss concept that we're talking about. So that really is the gateway provision. So again, anytime you have property transaction, you always first want to consider the amount of realized gain or loss. Even if you think you know, okay, some special rule or whatnot, you should always start here. Now, what exactly is property? Well, unfortunately, the tax law does not define the term property, or it's not defined in the Internal Revenue Code. It has been defined through various case law, and while it's not an exact definition, it's a very broad concept. The things that you might be considering right now as you're listening to this that are property most likely are, like a building, or equipment, or a home. Even intangible assets can be property. Patents, copyrights, things like goodwill. Those are all considered property. So property can be very, very, very broad. So whenever you're talking about property, you have to think about it in the broadest sense. Distinguish property from services. That's really the key, is that property is separate from services. When you have property, if you have a sale or other disposition, then we're going to have to calculate the realized gain or loss on that transaction. So let's first talk about what a sale is. And these definitions are defined in the actual tax law. So a sale is a conversion of property for cash or into cash. So if you have a conversion of property, which we just defined, and you convert it to cash, that is considered a sale. If the definition of sale is met, then we're going to continue down to the calculation of realized gain or loss. Now let's go back and focus on other disposition. So again, if you have property and you have a sale, you can get to the realized gain or loss calculation. But if you don't have a sale, then consider whether it's an other disposition. Other disposition is a lot more interesting because there is a lot more going on here. So other disposition includes exchanges and involuntary conversions or other similar events. Now, an exchange has been held to be property for other property differing materially, that's key, materially, either in kind or in extent. There was a Supreme Court case, Cottage Savings Association versus a Commissioner of Internal Revenue. And in this case, the issue really was with regard to the property being materially, either in kind or in extent, different. Just a little highlight background of the case. During the savings and loan crisis in the 1980s, where there were skyrocketing interest rates, a savings and loan company actually owned some mortgages that if it sold them, it could take a loss, which for tax purposes, taking a loss is good because it's going to lower your taxes. Well, due to some Federal Home Loan Bank Board rules, it couldn't sell those mortgages and take the loss. The savings and loan company actually found another savings and loan company in the same city, believe it or not. This is going to be one of those things that's like once in a lifetime type coincidence, that had the same almost identical amount of mortgages, the same low interest rate, and they said, let's make a swap. Let's do a 90% swap mortgages, and by doing the exchange, we can both take losses. So we keep 10%, we exchange 90%. The IRS came in and said, no. They're identical. They're identical in nature. That was really the issue in the case, the key issue in the case. Were they identical or were they materially different, either in kind or extent? And the Supreme Court said that these were actually different. One mortgage company had borrowers and the other one had other borrowers. So they were different with regard to the borrowers, so that created a different risk factor. Even though the interest rates were the same, even though the amounts were the same, even though the term was the same on these, which was an amazing coincidence, it was still different borrowers. So the idea here to understand is that this property for property differing materially, either in kind or extent, this can be viewed very broadly under this Cottage Savings Association versus Commissioner of Internal Revenue. So in that case, the taxpayer actually got a favorable decision because the taxpayer was able to create exchange and therefore take a loss. If we have an exchange, then we continue to the calculation of realized gain or loss. Going back to other disposition. So we're going to learn later on in other topics that to have certain tax treatment, you must have a sale or exchange. Now, with regard to this gateway provision, which applies to any property transaction, there's other types of dispositions. And the main ones, and there's all different types, but the main ones, sale, exchange, and involuntary conversion. Now, a sale and exchange are voluntary, meaning that you actually want to go ahead and make a sale. You want to make the exchange. Involuntary conversion, though, you don't have that ability. You don't have that choice, that volition. These are theft, seizure by the government, condemnation, natural disaster. And I say other similar events because there's other types of other dispositions out there that are not as common, but these really are the big three to consider. So if you have a sale, exchange, or other involuntary conversion, I gave some examples of involuntary conversion, again, where it's not your choice. Then we have to calculate the realized gain or loss, which again, that is the key in determining that realization event for income as well as losses. To calculate realized gain or loss, you need to keep this formula in mind wherever you go when it comes to tax. This is probably the most important tax formula out there. The amount realized minus the adjusted basis gives us a realized gain if it's positive or realized loss if it's negative. Those terms themselves are defined. Again, I want to highlight that anytime you have a property transaction, which is a transaction involving property, sale or other disposition, then you need to go through this first. This is the first provision you should always consider. You should start with this provision and determine the realized gain or loss. Again, even if you think you know what the ultimate outcome is, this is very important to consider first because with regard to special rules we'll learn about later that stem off of this general rule, it helps to conceptually know the realized gain or loss that will help you determine things with regard to the special rules. For example, when we talk about non-recognition rules later on, there's always a lurking gain or loss involved because it's simply a deferral mechanism, and you should know the lurking gain or loss. You can calculate that by looking at the realized gain or loss under this calculation. So in the next several videos, I'm going to talk about defining amount realized as well as adjusted basis.